From New York City for our viewers worldwide, I'm Matt Miller. We are counting down still another 36 hours until we get Nvidia earnings, but the market seems to want to sit on its hands and wait. The countdown to the open starts right now. Coming up, futures on hold with another busy day of Fed speak on the docket, so that's one thing we'll be paying attention to. Macy's and Lowe's posting better than expected quarterly results, so retail is coming in fine. And big tech hits another record high. Nvidia earnings tomorrow after the bell, already today in focus. We begin with the big issue, though, insight on the state of the consumer.
A moderation. And this is why it is dangerous to some extent for the Fed to wait so long, because we are not the economy of last year in terms of really firing on all cylinders. So things are moderating. The risks, there are more risks to the downside on the labor market in particular. I think you do see signs of consumers faltering, but they're not, those are risk case. We don't see them in the baseline.
Joining us to discuss now, David Sowerby of Ancora. And David, it's interesting to hear Claudia's take. It's the opposite of what Ed Yardeni was saying on surveillance yesterday, which is that the Fed has gotten us used to these normal interest rates, and we should stay here. If they cut, he thinks they could inflate a bubble. What's your view?
I think first that the state of the U.S. consumer is still very healthy. Consumers defy the law of gravity. And in my career as an investor, I've always thought, never bet against the U.S. consumer. And that's why I'm still overweight consumer discretionary stocks, large cap, small cap. So I think it's still a better than average backdrop. And there's always going to be risks, Matt. But I think the biggest risk is not taking enough sufficient risk.
A lot of talk about moderation. Claudia was just talking about that. I heard someone say yesterday that we're moderately moderating. Is the consumer still, I know, going to be the growth engine for this economy, right? There's no other choice, but still as strong as this consumer was coming out of the pandemic, because we've seen higher income consumers supposedly step down to shop at places like Walmart, and obviously debt continues to be rising and even difficult to judge.
But we take a step back and look at how many consumers have no mortgage or a mortgage rate at 3.5% or even lower. They've been very good, much like U.S. corporations, at locking in low-cost debt and extending the duration. There's still some excess savings left for the U.S. consumer. The key will be, on a go-forward basis, as long as real after-tax income, real disposable personal income, is growing 2 to 2.5%, that sets the backdrop for health in the consumer discretionary sector.
We saw a report today out on New York. I mean, you mentioned a lot of consumers don't have a mortgage here in New York. That's because they're paying rent, and only 5% of the apartments here are affordable, according to Zillow. If that's the issue in the big cities, isn't that a problem?
It can be, but if you think about this country in aggregate, you know, where I live in Michigan in the Midwest, there's this manufacturing renaissance that's taken place with onshoring, reshoring, a Michigan unemployment rate on par with the U.S. There's so many good features once you get off, politely said, once you get off Main Street or off Wall Street and get on Main Street, the U.S. household, I think, is still in better than average shape. I'd give it a solid letter grade B, maybe a B+.
Got it. All right. I want to get to the Fed speak that we've been watching already all week. It feels like it's been a while. Of course, we're only on Tuesday, but it continues down on Amelia Island. Bloomberg's Michael McKee is there, and he caught up with Cleveland Fed President Loretta Mester yesterday. Let's listen to what she had to say.
I was on the record before saying I was at the median, which was 3. The developments I've seen in the economy right now, I would not think that that's still appropriate because the inflation risks have moved up.
Michael McKee joins us now from Amelia Island. So Fascinating exclusive interview there yesterday with Loretta Mester. Mike, what do we hear today, and what are we waiting for still?
Well, everybody's waiting on Wall Street for some sign of when the Fed might cut, but they're pretty unanimous in saying that they're not going to tell you. 3 is off the table, Loretta Mester says, but she's been saying that, and so have others for quite some time. The question is, what might be on the table? And everybody's answer is they have to wait and see the data. We get a lot of Fed speak today. Not everybody is talking in areas where they might make some news, but Chris Waller is speaking now, and later Susan Collins from Boston will add her voice to the whole thing. So we should see at that point another couple people who have waded into the debate. Waller is interesting because he's a little bit more optimistic than he has sounded in the past. In his speech today, he's saying more recent data on the economy indicate restrictive monetary policy is helping cool off aggregate demand, and the inflation data for April suggests progress toward 2% has likely resumed. And in the spirit of let's you and him fight, I'm going to give you guys something to talk about on the Open this morning, Matt. Chris Waller takes objection to the Wall Street view that the Fed is overly data dependent. He says in his speech today, I hear from some quarters that claim that the FOMC has become overly data dependent. This is a phrase that honestly doesn't make much sense to me. The median projection for the appropriate level of the federal funds rate at the end of 2024 moved by at most 50 basis points between the 4 summaries of economic projections over 2024 and more or less held to the median of 3 25 basis point rate cuts over the past year. That hardly seems like an overly data-dependent Fed to me. So an interesting argument he's raising for the folks on Wall Street to debate. He's defending the Fed. Meanwhile, we haven't seen much movement at all in Fed funds futures. The forecast is still pretty much the same, maybe November and likely December.
All right, Mike, thanks very much. Michael McKee, their international policy and economics editor out of Amelia Island. David Sowerby is still with us from Ancora. And, of course, you point out, David, the difference between Wall Street and Main Street. Consumers on Main Street are still spending money on what? On fixing up houses, cars. I heard you talking to Tom Keene and Paul Sweeney on Bloomberg Surveillance this morning about the stocks that you like being beneficiaries of your check writing for home improvement projects.
That's the case. It may not be traditional retail. We know Macy's had a better than expected number, but the stock is still significantly lagged since before COVID. But to be overweight consumer discretionary just doesn't have to be traditional retail. It can be Wyndham Hotels. Leisure travel is 70% of their business. 9,000 hotels that they own on this planet. They're buying back shares because the stock has been a bit challenged out of the being the target of choice hotels. So there's a leisure play. On the home side, I think a name like IAC, which is Angie's List. So somebody who wants to do remodeling, construction, you name it, they go to Angie's List as a source. That's part of IAC, as well as some media, digital, as well as print. I think there's going to be still more consumer spending on the leisure side, on the service side. Maybe not so much traditional retail, but the consumer, again, they'll defy gravity.
Is this part of, are these picks part of your thesis that the success we've seen in terms of earnings and stock price appreciation has to broaden out? Are you seeing real evidence of that, David?
Slowly, Matt. The rubber band we know is stretched. I lived through it in early 2000. The rubber band then was very much stressed, but there were different names then. It was Cisco, it was Intel. Today we know it's Nvidia, as well as a few others. So I think that when that rubber band eventually snaps back, we saw a period from 2000 to 2007. The S&P only compounded at 2.5% annualized return, but the average stock, equal weighted S&P 500 index, compounded better than 8%. I think that's still a good backdrop if you're finding companies that are growing their free cash flow in the high single-digit range and returning that with dividend growth of a similar growth rate of 8 to 10%. I think that's a pretty good backdrop. Back to my original view, there's risk in not taking sufficient risk.
I know that free cash flow and the return of that cash is important to you as well. How important is Nvidia tomorrow? I mean, a lot of people are saying traders already sitting on their hands waiting for these results to come out, and it's not till after the bell on Wednesday. Is it that monumental?
Well, you call it the Super Bowl, the last episode of Dallas back in the TV days. It's front and center, but I'll give you a little different name. Broadcom, since the end of 2001, bear market, bull market, it's compounded 40% to the investor, not quite in the Nvidia stratosphere, but it sells at a significant discount to Nvidia, as well as even a discount to the S&P 500. So while I get it's all about Nvidia, it's more going to be about the other 499 stocks in the S&P 500, small caps, mid caps as well. This market will broaden out.
All right, David, thanks so much for joining us. David Sowerby there from Ancora, talking about the stocks that he likes, the importance of free cash flow, Nvidia, and who shot JR. Joining us now with a look at the stocks moving ahead of the opening bell, here's Abigail Doolittle.
I've not heard the Shodells mentioned in quite some time, Matt. That was good stuff for sure. As for stocks beneath the futures, the relatively flat futures for the S&P 500 at least, let's first take a look at the shares of Macy's. They are trading up 3.3%. They beat in a massive way, putting up 27 cents. That was 93% better. So investors liking this, thinking that maybe there's a turnaround in place. And it also perhaps takes some pressure off of activist investors, I should say, amid buyout talks. Lowe's up nearly 3%. They beat estimates, despite the fact that their comps fell 4.1% in the 4.1% in the first quarter. That was better than estimated, and apparently they're getting a big boost from pro contractors. And then Palo Alto Networks, not so much, down 6.6%. They put up a quarter that was disappointing. The sales forecast, even more so disappointing. Investors looking for something that was at the higher end of the range that they're looking at. And this, of course, if you recall, Matt, back in February, they put up a brutal quarter and forecast. So this is the second time in a row. I think the stock dropped something like 15-20% on that right now, down 6.6% in the pre-market.
All right, Abby, thanks very much. Abigail Doolittle there with a look at some of the stocks we should watch today. Coming up, Macy's beating profit estimates.
Is discerning right now, and we expect that trend to probably continue for most of the year.
The consumer in the spotlight as retail earnings wrap up. That conversation still ahead. This is Bloomberg.
They noted in their release they had to move some summer seasonal and spring seasonal items to get inventories in better shape. So that was smart for them. We think the consumer is discerning right now, and we expect that trend to probably continue for most of the year.
Macy's handily beating profit estimates, leading the department store to raise its outlook for the rest of the year. But Tony Spring, Macy's chairman and CEO, sending a warning about the consumer. He told Bloomberg, quote, consumers remain under pressure despite strong job growth and wage growth. Joining us now for more on Macy's is Bloomberg's Romaine Bostick, anchor of The Close. And as I understand it, Romaine, you were on a call with the CEO this morning.
Choiceful purchases, Matt.
Choiceful.
That's exactly how the CEO referred to it, Tony Spring here. It's kind of interesting. I mean, he made it clear here that inflation is an issue for a lot of their customers. He made it clear that some of their more affordable products, meaning those private label products, aren't doing as well. Now, the flip side of that is they did actually see a lot of growth and, more importantly, a lot of stability on the luxury side, pretty much on the Bloomingdale side when it comes to women's apparel and women's shoes, and in Bluemercury, which is largely their cosmetics and skincare brand of products.
What about the spring turnaround? What's the plan for that?
Well, they're doing well. They're touting this first 50. These are basically the sort of first 50 stores that they say are kind of the prototype for what they want Macy's to be. These are the ones that they've already made big changes in, not only in the store format, but in allowing vendors and other things on site. And they think they can extrapolate that to the other, 300 plus stores that they currently have out there as they try to shift. But Tony Spring was very clear. Look, I mean, he just took over this job in February. They're, in his words, the first inning of this, basically the first quarter of this. And it is going to take some time, Matt, but he does see a lot of sort of green shoots, if you will, particularly when it comes to apparel, particularly when it comes to cosmetics. And here's what he also told me, Matt. He says this year, this fiscal year, 2025, they're really going to push really much more deeply into home furnishings.
All right, I have actually purchased a couch at Macy's. It was about 20 years ago, but it was really good.
Well, thank you for doing your job.
Really
I think Tony Spring would appreciate
Romaine,
that.
thanks very much. Romaine Bostick talking about his conversation with the CEO of Macy's. The earnings out, of course, they're fighting off a $6.6 billion buyout offer from activist investors. Let's talk more about it with Oliver Chen, TD Cowen Senior Equity Research Analyst. He has a $20 price target and a hold rating on the stock. They're just about there. I saw it flash up at 1973 in the pre-market. What do you think, first and foremost, about the Ark House and Brigade Capital Management $6.6 billion offer? I mean, should that be pushed away? Should they be defending it with a spring turnaround?
Yeah, Matt, they'll always have to consider what's in the best fiduciary position for shareholders. So evaluating this is important. However, financing may or may not be tough to get in terms of the deal. Macy's is well capitalized at 1x debt to EBITDA, but the challenge ahead is fairly substantial in terms of what the company needs to do. The bottom line is that Macy's needs younger customers as well as fixing its overall apparel business. They are underway in doing this quite intently. We're seeing some early green shoots, but as everybody mentioned, the consumer's in a bit of a tug of war between needs versus wants, and basically suffering from the anxiety of inflation, looking for deals, looking for values. So there were markdowns to pay attention to in terms of warm weather apparel, and that's something we're watching as well. The top 50 stores, the growth 50, were better than expected. That's a positive factor as well. But free cash flow generation, capitalization, those are strong positive points on Macy's overall.
How much of a problem, in your view, Oliver, is inflation? Because Justin Wolfers from the University of Michigan was talking on Surveillance last week about how, for most of America, wage growth has eclipsed the climb of inflation. But for the top quartile, for the top 20%, which is, I assume, the shopper that Macy wants to get in its doors, inflation has been much worse than their ability to earn more money. So how do you view it for Macy's?
Yeah, what we are seeing encouragingly at Costco is that inflation is getting less bad, flattish, disinflation, even deflation. However, consumer confidence is still fairly volatile, and bifurcation is happening with more pressure in the middle and lower ends. So what's happening with discretionary generally across retail is the consumer is waiting, pausing, looking for deals, looking for better deals, and just delaying some of these discretionary items. Also spending on other items such as services and travel, that's been a factor too. So it's something to watch. At the high end, we do have a robust customer, but it's mixed as well. For example, we see higher end customers trading into Walmart as well. Quiet luxury is a trend, logos less so. So we're looking at those trends within luxury as well. China, something to watch too, is mixed. Bottom line, our preference on stocks is Walmart, Costco, and Ulta. The beauty sector remains vibrant.
I just want to point out we're getting headlines across on Nvidia, those shares dropping in the pre-market a little more than 1% after a Financial Times report that AWS is halting orders of those chips. Of course, that's Amazon Web Services, the all-important cloud business. And again, the Financial Times is reporting that AWS is halting orders of Nvidia Hopper chips, awaiting a new chip. We're following these details very closely, Oliver, because, as you know, even though you're covering retail, it's all about AI. It has been for over a year. Is this something that retailers, that Macy's, is this a technology that they can put to good use, and have they been?
Yeah, Matt, what we see ahead for AI is large language models as well as computer vision. Walmart's a little further in terms of using computer vision, artificial intelligence for inventory management. What's happening in retail is search and the transformation from keywords to talking to your computer or your search bar like a human. And that is being employed at Macy's as well as Walmart. We're most impressed with Walmart and their use of AI, in part because of the Walmart Plus loyalty program. But we're excited. I mean, AI has the power to unlock better merchandising, labor, as well as inventory reductions, and specifically merchandising, greater full price selling. So it will change the world, and I'm quite focused on this as a topic as well.
Yeah, and I saw, Walmart's online sales were up, I think, 22% in the last quarter, a huge driver of their of the gains that we saw that the Wall Street was pretty impressed by. And I think taking a chunk, at least a small chunk, out of Amazon's market share. How is Macy's doing with its online presence? I know the spring turnaround is about, I think Romaine was saying, women's shoes, and they want to get more furnishing out the door. But how much are they doing online?
Yeah, the marketplace is a big opportunity, meaning using third-party sellers, meaning vendor-managed inventories. And Macy's is really focused on that, too, in terms of complementing its own online offering. Furthermore, the Macy's loyalty program is very important for maximizing customer lifetime value. So the key here is to really connect both online and offline to make a better customer experience. But that being said, this physical retail footprint is the most important, and they need to be more theatrical, more experiential, more differentiated. You went there 10 years ago. You need to come back. You need to have a reason to go to stores that you can't find online. In part, this will require a renovation of the apparel portfolio and their own brands to become younger, more relevant to the customer. And customers want a store experience that's not very cluttered. They want a curated experience that has good service as well.
Oliver, great having you on the program. We'll have to have you back soon. Oliver Chen there, coming to us from TD Cowen. Coming up, the morning calls, and then later on, eToro's Ben Laidler joins us around the opening bell as we look ahead to big tech's make or break moment. This is Bloomberg. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Barclays upgrading HP to equal weight, saying hype surrounding potential AI PCs should provide some support for shares. They want to make personal computers that are AI machines. Next up, Citigroup opening a positive catalyst watch on shares of The Gap, expecting the retailer to deliver better than estimated profits when it reports earnings next week. And finally, Baird downgrades Toast to neutral, seeing slower growth ahead and a more balanced valuation following recent gains. This is Bloomberg. This is the countdown to the close. I'm Matt Miller. After a fresh record for the S&P 500 yesterday, we're looking at futures that are pointing lower ahead of the opening bell. We can see the S&P futures at 53.23, and there you hear the bell. We'll see if the Nvidia news drives this market lower. Reports from the Financial Times that AWS has halted its order of new chips, waiting for the next new thing from Nvidia. Let's take a look at some of the other assets moving at this hour. We have the euro right now unchanged at 108.58, the U.S. 10-year yield at 4.40, and oil down about 1% at $78.95. One of the stocks you want to watch more closely at the open is Lowe's. That retailer beating estimates after a boost from pro contractors despite a weak housing market. Abigail Doolittle has more on Lowe's. Abby?
Well, Matt, it was a solid beat. They beat adjusted earnings by about 4% to put up $3.06 in adjusted earnings on sales of $21.36 billion. That was also a beat of about 1.1%. Now, same-store sales or comp sales, a key metric that the industry does follow, fell 4.1% in the first quarter, but still better than expected. And as you mentioned, while a lot of the do-it-yourself fixed home fixers have been on the sidelines to some extent as the housing market has been, a little bit stalled. Pro contractors, professional contractors have been out there and helping Lowe's have this solid report. The shares off of the pre-market highs, but nonetheless still up 0.6%, and over the last year or so up more than 10%. So a solid showing for Lowe's.
I need to get over there, actually. Maybe after the show, I need to pick up a pressure washer.
Weren't you just at Home Depot last week?
I was at Home Depot.
Which do you like better?
Well, actually, I don't know where the Lowe's is in my area. I live in kind of a Home Depot area, maybe.
There you go. So you're forced there.
But I'll look for one because I heard they have a very good pressure washer deal. Abigail Doolittle, thanks very much for that. Sticking with retail, Macy's raising its outlook for the remainder of the year after beating profit estimates. We were talking about that this morning. Simone Foxman is here with more. Simone?
Yeah, Matt, the market's clearly reacting to the green shoots that CEO Tony Spring is talking about in some of his turnaround strategy. As you've been talking about a lot this morning, he has outlined a strategy investing in new products, new displays, and customer experience. And early signs suggest that this is bearing fruit, stronger growth in some of the stores that have seen this kind of turnaround. But the numbers there looking good this morning. First quarter earnings per share coming in about double what was expected at 27 cents a share. Second quarter earnings per share look to be like they will be above the initial estimates as well. And the company able to raise its sales and earnings forecast for the fiscal year. That said, sales will still fall 1 to 3%, it expects. But comp sales were also down 1.2% across its locations, even though Bloomingdale's and Bluemercury, its luxury skincare and fragrances and beauty products line, was up. Beauty strong across the board. We heard from the CEO this morning. Citi said this beat on sales is encouraging, implies the second quarter is off to a decent start. But on the call just now, we heard from the company executives that they do see a consumer that continues to be pressured. They think that they have the flexibility to respond over the course of the year. And we're looking at shares now up 3% in early trading this morning, Matt.
All right, Simone, thanks very much. Simone Foxman there on Macy's. Let's turn now away from retail to software. Palo Alto giving a downbeat forecast, renewing concerns about a slowdown in cybersecurity services. Isabel Lee is here with more. Isabel?
Hey, Matt, shares are lower as much as 7.3% when the market opened, and this is the lowest since February 21st. So you're right, it's really the downbeat forecasts that are causing investors jitter. So we have forecast for the revenue range. It was lower than analyst estimates. We have the projected fourth quarter billings, which is a closely watched benchmark, which is in line. So the tepid outlook is causing extra jitters because this follows the disappointing report we saw last quarter, which led Palo Alto to see its worst single-day drop ever. Shares are now still edging down, and at that time, the CEO said that, investors are just seeing signs of what they call spending fatigue. Well, now during this call, the CFO said that, okay, we admit there's significant volatility in billings, but he argued that it's really due to payment terms, and he said that there are other more relevant metrics. And overall, the executives still remain kind of bullish. They said that they expect cybersecurity spending to continue because the attacks continue. And they also pointed to sophisticated breaches. And they said that, customers are more focused on securing the cloud. But for now, shares are down as much as 6%. But year to date, it's up 2%, Matt.
Got it. Isabel, thanks very much. Isabel Lee there on Palo Alto. Now to the all-important chip maker, Nvidia, dropping after the Financial Times reports that AWS has halted its orders for Nvidia's most advanced superchip. AWS, that is, of course, Amazon Web Services, waiting for a more powerful new model to come out. Katie Greifeld is here with more. Katie?
Well, we take a look at what shares are doing, and they're down a little bit on the heels of this reporting from the Financial Times. Like you said, Amazon Web Services, which is, of course, the largest cloud computing provider, it's halted orders of NVIDIA's most advanced superchip to wait for the new model. Specifically, it's halting orders of the Hopper chip to await for its new chip. Remember, back in March, NVIDIA unveiled a new generation of processors that were named Blackwell. That announcement came barely a year after Hopper began to be shipped to customers, but you had NVIDIA's CEO saying that the new Blackwell products, they're going to be twice as powerful for training large language models, which is, of course, the technology behind ChatGPT. And it seems like Amazon would rather hold out for those new models than buy the Hopper. AWS specifically told the FT that it had, quote, fully transitioned its previous orders for NVIDIA's Hopper superchip, which launched in August, and replaced replace them with the successor, the Blackwell model. So they're not canceling the orders, but of course nerves are high right now because Nvidia reports earnings after the bell tomorrow. That might explain why you're seeing a bit of a dip in the shares right now, down about 0.9%. But just for some context, Matt, Nvidia is up about 90% year to date.
All right, so they're not doing too badly, even with today's drop. Katie, thanks very much. We'll be following that story, obviously, very closely. The transition from Hopper to Blackwell may be an issue tomorrow on the earnings call. That's after the bell. Joining us now is Ben Laidler, Global Market Strategist at eToro. And Ben, I don't know if we're as focused on AI this year as we were last year, but it seems to be the most important issue, at least after the Fed in these markets. What's your take on Nvidia?
Yeah, I would agree, right? There's two pillars for this bull market. There's the Fed cutting interest rates and there's earnings growth. And all that earnings growth is coming out of AI and big tech right now. So yeah, absolutely. Nvidia results are important. It feels like it's almost become a sort of macro event. You know, Nvidia's market cap is bigger than all the stocks in China or all the stocks in France right now. So yeah, it's important. But I guess I would just say two things. You know, they're going to miss at some points. Right, you can't just beat and raise every single quarter ad infinitum. I think they're going to be fine this quarter, but you know, I would just say two things. We've already heard from their customers. We've already heard from their competitors. Business is great. So if they are going to miss, you know, it's going to be small fry. And the second thing I would just say is, you know, the rest of the market performance is already beginning to broaden out. I see that trend continuing. So I do see some air coming out of the big tech balloon naturally over time. And just remember, a little bit of money coming out of Nvidia and big tech, given how supersized they are, goes a very, very long way in some of these smaller sectors and other parts of the world.
I just got a message here, Ben, from a viewer asking, is this what 2000 felt like? Everyone waiting for earnings from one company? It does feel a little frothy, right? I mean, another year of double-digit gains already, and we're not even in June. Every chip is on AI. Are you a little concerned that there are too many bulls? I mean, after Mike Wilson's capitulation yesterday, Kolonovich is the only bear left.
Yeah, let me try and answer that two ways. So firstly, you know, Cisco, which was the Nvidia of 2000, peaked at 100 times PE. And frankly has never recovered. Nvidia's on 35 times, right? We can quibble about that, but you know they are delivering on the profits growth. Profits are going to quadruple tomorrow. Secondly, you know this has been a pain trade, even with you know the Morgan Stanley capitulation. I think the sell side consensus target for the S&P 500 this year is still below where you are today. And I think you see elements of that, you know, everywhere. There's still $6.5 trillion sitting in money market funds. That's an all-time record. Our investor sentiment index is average. It's not, you know, it's not full. Retail sentiment is well off its highs. You're seeing mutual fund outflows. You know, I could go on and on, but you know, sentiment is not low, but it's nowhere near the high. So I think this is a pain trade that and a slow capitulation that continues to give.
I would be remiss if I didn't play you some of the sound we got from Morgan Stanley's Mike Wilson. He was on Bloomberg Surveillance earlier.
It just reflects the uncertainty that has been the case for the last several years. All of these are very possible, and you know, they could all happen with a higher than normal degree of, you know, certainty. So that's really the headline that should have been out, is that, look, nobody knows anything, right? I mean, and particularly at a point in time. And I think maybe our mistake is just admitting that we don't know as much as maybe everybody else claims to. That's called humility, something that we've learned the hard way over life.
When he capitulated last year, that's when the market turned around and started going down again. What do you think is the biggest risk, Ben, to this market? I've heard a lot of people talk about the labor picture. If people start to lose jobs, is that the end of this?
No, because I think you have the insurance policy, which is out there, which is the Fed could just go and cut interest rates. I think the risk is the other way around, and we may get a sense of that with the Fed minutes tomorrow, which I think is the other, you know, big issue tomorrow, is, you know, if inflation doesn't cool, if the Fed gets forced to hike interest rates, if, you know, we're not going to have rate cuts, that, you know, does two things. That will bring down valuations. It will also ultimately cool the economy and bring down earnings. And that's a sort of double hit that this market is not prepared for. So I think that's a tail risk, but that I think is the biggest risk in the market right now.
So, I mean, how confident are you that inflation will cool? A lot of people, including Jamie Dimon at the JP Morgan conference a couple of days ago, saying he doesn't think that's going to happen.
I think it's going to cool. I just think it's going to take, a bit longer than expected. Why? Because you've got 5.5% interest rates. There is a lag on that. Because we're having a productivity boom, we're doing more with the same. And because a lot of these sort of stickier components, whether it's, shelter, whether it's insurance, whether it's healthcare, I think are probably lagging and will catch up or catch down, hopefully, over time. But you're right. That's the risk. I just think that maybe it's a little bit overdone.
The accelerating or ongoing market broadening is another thing that a lot of investors have talked about. That's got to be a bright spot for you as well. How quickly is that happening, and where do you see the most evidence of it?
I think it's happening, and it's happening most notably internationally. China's flipped from a bear market to a bull market. Europe continues to motor on. Japan continues to motor on. That shouldn't be a surprise. These are the markets which are, in the case of Europe, going to cut interest rates first. And they're also the most cyclical markets. They're the ones that are most sensitive to this turnaround in the economy, which we're expecting. So I would say globally, what we're looking at, I guess the canary in the coal mine is going to be small caps. I suspect that takes, a little bit longer. But I think we're absolutely seeing the broadening to cyclical parts of the world and to cyclical sectors, like financials.
Ben, what is the risk of a Trump presidency and then Jerome Powell out the door? Does that concern you at all?
Yes, we're climbing a wall of worry here. I'd be, I'd be naive if I didn't have a long list of things to worry about. I just don't think that any of them are going to be big enough to derail this market. I think we are seeing an earnings recovery, which is slowly building, and we are seeing, and interest rate cuts are on the table. They're going to be quicker in the rest of the world, but they are absolutely coming in the U.S., and I don't think a Trump presidency is going to derail either of those two things.
We certainly have seen earnings continue to ramp up over the past 3 quarters, and I know analysts are raising estimates into Q2 as well. Ben, thanks so much for joining us. Great to get some time with you this morning. Ben Laidler joining us from eToro. Coming up, the global chip industry remains in focus.
Taiwan is at the epicenter of the world's technology supply chain. Without Taiwan, it would be very difficult for Michael and I to do our jobs. It would be very difficult for us to serve Bill and his company.
Always in the leather jacket. Nvidia in focus ahead of earnings tomorrow. That conversation still ahead. This is Bloomberg.
Taiwan is at the epicenter of the world's technology supply chain. Without Taiwan, it would be very difficult for Michael and I to do our jobs. It would be very difficult for us to serve Bill and his company. And so the technology industry depends very heavily on Taiwan and continues to for some time.
And that was the CEO of Nvidia, Jensen Huang, speaking to Bloomberg's Ed Ludlow in an exclusive interview. Shares of Nvidia right now are down 1.5% after the Financial Times reported that Amazon has halted orders for the Grace Hopper chip. That's Amazon Web Services, AWS, waiting for an even more powerful chip, apparently called the Blackwell. Bloomberg's Alex Webb joins us now for more on, our expectations, Alex, are huge, but this company is used to huge expectations and in the recent past, at least, delivers.
Yeah, they've managed to beat and beat and beat again. And every time, actually, the earnings come up, if they don't beat expectations, then that's considered very disappointing. Like if they meet expectations, essentially, that's if they meet what the analyst consensus is, that's often considered a miss. And you would see that in the share reaction. But so far, it's all been pretty good news. I think the challenge with this FT story that people are asking themselves is there going to be a dip in demand ahead of the release of Blackwell in the fourth quarter? If so, then you might expect a slightly disappointing forecast for the quarter we're in right now and the calendar third quarter. So, that's why there is this share reaction. I think people expect, though, that in the medium to long term, it's all going to be fine.
Yeah, I mean, surely analysts who follow this company professionally are going to know if demand will lag when they introduce a new model. The same thing happens with car manufacturers all the time, and I imagine it's nothing new with chip makers either. This isn't the only chip maker in the news today, Alex. I thought it was pretty amazing that ASML and Taiwan Semiconductor would be able to turn off machines that make the highest tech chips in the world. This is in the case of China invading Taiwan, but I guess they have the technology to turn off these machines remotely for any reason they want.
I mean, in a sense, it maybe isn't that surprising when you think about the nature of the Internet of Things and the industrial internet, much of which is about being able to monitor and, of course, then perhaps control remotely industrial machinery. And this is like the ultimate piece of industrial machinery. The extreme ultraviolet lithography machine obviously is the top of the range, with the high NA coming out sort of shortly. But of course, this presumably applies to lots of different things, including deep ultraviolet lithography, and some of those machines are already in China. So it is something that perhaps doesn't surprise me. It's something interesting that they can, and perhaps provides a little bit of relief to anybody who's concerned about, what would happen if China were to invade. There are bigger issues, of course. If China were to somehow invade Taiwan, sort of just for the chip industry, they wouldn't be able to get all the components that are needed to make these chips. So there are lots of different reasons why just having these factories would not mean that they can replicate what Taiwan does.
I thought it was interesting that someone has essentially a remote control, because they can turn it off if China invades Taiwan. But what if China gets hold of the remote? Like, this is a technology that someone you don't want could hold on to and then control the chip-making machines for the world. I just think it's absolutely fascinating, if not surprising. What are the expectations for this market, Alex, the chip market going forward? I mean, can anyone catch up to Nvidia? I know that Pat Gelsinger and Intel have been getting lapped, but hope that with enough investment and a couple of years, they'll be able to.
I mean, if you look at the runners and riders, of course, like Intel isn't really in this space. It looks as though Nvidia is starting to encroach even more on Intel's space. The other player that people have been looking at is, of course, AMD, which for a long time was the most comparable company to Nvidia. Nvidia's really stolen a march on AMD. AMD is looking at adding maybe $2 or $3 billion in revenue from these, AI accelerators, while Nvidia, in this quarter that's about to report, the market's looking for $24 billion in revenue, up from $7 billion a year ago. So, it's just completely different leagues of growth. The final one in this space is, it's a little bit of interest in what's going on in Japan, right, with SoftBank. They are talking about trying to bring a developer competitor to Nvidia, and the challenge with that is like how they do that in a short time frame. Goodness only knows. It requires a huge amount of capital, and coming from a standing start, it seems like a huge challenge.
All right, Alex, thanks very much. Great to have you on the program. Alex Webb writes for Bloomberg Opinion and focuses in on, obviously, the tech industry, which he knows so much about. Let's get to some other sector action this morning. For that, we go over to Bloomberg's Abigail Doolittle. Abby, what are you watching?
Well, the sector composition really reinforces what you've been talking about. Investors on hold until those Nvidia results. The S&P 500 itself down ever so slightly. More sectors right now at the moment higher, but that's only because communication services is up fractionally. Just a moment ago, it was the opposite. So utilities, the best sector, up 0.7%. This as yields go down. Those dividends look more attractive. The same with consumer staples. To the downside, it's consumer discretionary and technology. Let's really focus in on tech, because the stocks, the chip index, underperforming, down 1.1% on Nvidia and some of these other chip makers. If we take a look at the stocks from the last Nvidia report, we will see that it is up 13%, a very healthy pop. But what's really interesting here, Matt, is the stock still has not put in another all-time high. So this index is essentially lagging the S&P 500 and the NASDAQ. I'm not sure exactly what sort of a tell that is, but it's a divergence that's certainly worth watching going into this high-pressure Nvidia report tomorrow after the bell.
Yeah, I think that is interesting. As Alex points out, and rightly so, because I lose track of this so often, there are so many different kinds of chip makers, right? And somebody like Nvidia is doing something very different than, a DRAM manufacturer, or even Intel, for that matter. Abigail Doolittle, thanks very much for looking at that. Coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg. Time now for the trading diary. This is what you'll need to be watching this week. Fed speak from Barr, Bostick, Collins, and Mester again this afternoon. Tomorrow, obviously, we get Nvidia earnings. They're out after the bell, an earnings report you won't want to miss. Plus, we're going to get Fed minutes, as we've been talking about this morning. Thursday, we get initial jobless claims, along with new home sales. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.